Hi everybody, Brian here from quantlabs.net. Saturday the 19th of September, 10:23 a.m. What I'm about to show you is a bunch of scripts that I have written years ago that I decided to bring back and look at the post effects of this pandemic, this coronavirus business, to see how the US is doing. And this first chart we're looking at here, called the continued claims insured unemployment, looks pretty scary. I purposely keep the chart all the way back for a historical purpose. What I do find when I used to run this, there's a lot of manipulation going on with the Fed, and this is from the St. Louis Fed or Fred database. So here in the continuous uninsured unemployment, I've talked about this in past webinars. You can see here how it's just spiked from since 73 all the way up to 2.5, which is quite shocking to see. And this is what they're trying to knock down. Here is the durable good orders. These are the actual orders of product made in the States. You can see this dip here where it's been steadily increasing up until even the recession. This is a good comparison here. So you can see here how deep this has affected durable goods made compared to 2008. It's not quite. Not only that, on that dip, you can also see the recovery is, I'm going to say, about 3/4 of the way before the pandemic hit, which is pretty good. Also, when you look at the GDP here, you can see here since 1953 all the way up, GDP has been running up pretty solidly. Had a dip here to about to here, so it takes it back to the 2013 period, and no sign of recovery yet on that. All right, so the next one's the industrial production index, which is similar to durable goods. Here you can see that dip again in 2008, the pandemic, not quite as deep, but if you did a measurement on the amplitude, I'm sure you could probably say it's probably equal or more. But it does take it back to the period of, I'm going to say 2008. It's about, from what I'm seeing in here, if I was to look at it, you could probably say it's about halfway recovered so far. So it's a pretty good bounce back compared to 2008. You can see why these politicians are wanting to keep the economy humming and not go into a lockdown because of it. Also, we have here production business equipment. Obviously, a lot of that would have been outsourced, but there have been previous dips, again, 2008. Here it's deeper now. I guess that's because everything's been offshore from the States, but still the recovery is about, I'm going to say, 2/3, 3/4. So it's a pretty fast recovery. But if they do go into another lockdown, it would definitely affect the economy. Here's production for durable consumable goods. Now these are segregated out to know the difference between business equipment and consumables by durable consumer products, namely products that you use probably every day, like shampoo and stuff from companies like Procter and Gamble or Colgate. We can see here this big dip, very, very steep, down to 60, quite a bit more by a quarter than 2008, but it seems to have fully recovered, pretty close to it. So it's not as bad as you think, at least on the recovery end. Production manufacturing now is a little different. This probably would include your autos and planes as well. And same, little deeper than 2008, recover about 75%. Oh, and that's also the NAICS as well, for those that follow this. Industrial production materials, these are actual input materials going into production. This one, not as good in terms of the recovery. It's as steep as 2008, but it's just under half the recovery there. So here we have mining. Mining was deeply affected. This is the first time where it did uh, dip, not just because of 2008, because when under Obama they wanted to get rid of things like coal mining. Under Trump, he promised, you can see this little activity here, has dipped back, no recovery yet for that. This is another important one where you can see customer inventories. So what we look at when you net all this all out, you have the net, which is the cyan, and it's pretty well at a low point now at 2019, which is good because they've worked off the inventory of all the products they had made, went into lockdown, that went into storage, worked off that inventory, and it's at an inventory low. So that's probably one of the other reasons why production is starting to ramp up, because of inventory is pretty well at a low point. Also, manufacturing imports. These are input costs. You can see they've risen quite a bit. You'd think under China that it would be lower, but it looks like it's probably been outsourced out of China to other countries like Vietnam and other Asian countries, I'm thinking here. Always watching this cyan here. Next one here, we don't have a real answer for it, but that would have been the inventory index, but I do believe that is at a low point. Here we have order index, so good to know here. We did hit a low point even. It does look like it's fully recovered now pre-pandemic. As I said, when you factor in the inventory's been worked off, so manufacturer's been ramped up as well. So obviously got to order in product for input into other product. This one's pretty interesting. We got manufacturing new order. You can see here it's dipped quite a bit, and it's pretty well going back to 2018. So if the election turns out November 3rd for the U.S. Under Trump, because it's going back to it goes back to 2007. You can see here how it really affected 2008, but it's really bounced back. So if you measure 2016, where it did bump up a little bit and held its own pretty good. So if that was to continue, maybe Trump might help out there. I don't know about Biden, but that's another story. Okay, so here we have non-defense capital good, excluding aircraft. Okay, for non-defense, it's obviously taken out things like military and aircraft, because aircraft can be a huge portion of the U.S. industry. And here the dip isn't too bad, and it looks like it's come back on that on the manufacturing front. So here now we have non-farm private payroll. This is where it will get scary. You can see here the dip wasn't too bad in 2008, from just over 11,500 to between, I'd say, 10,700, and it went all the way up to just under 13,000, dropped back to 11,000, so it's a 2,000 point drop. That's a lot. And the recovery is not even halfway. I believe a lot of this private, now remember, this is private payroll, including just non-government. So when you factor that in, this is probably one of those scary stats where it has not fully recovered, meaning automation is kicking in to replace those lost jobs of the last, since the pandemic has hit. So building permits, you can see that massive drop. This is the reason why the drop hit in 2006-07 with the artificial mortgage fiasco. So that dropped all the way from just over 2,250 down to 500. That's huge. Has worked its way up to 1,500, dropped back to 1,000. So it's starting to normalize now again, which is good for that. All right, so composition. Okay, so this is the PMI. So these are the manufacturing, how they feel about manufacturing outlook has dropped, but it has somewhat beyond recovered since the pandemic. So a lot of manufacturers are feeling pretty good about their future. All right, so here, let's see what we have here. We have this is quite an interesting one. University of Michigan Consumer Sentiment. So since 2008, it has not dipped at all. I'm not sure if this stat is being collected at all. I don't see 2020 on there. Unemployment rate. I've talked about this on the real-time debt clock. You can see here it's dropped back from 10, and that pandemic has shocked it all the way up to 15. I believe it's a lot higher than that with the real-time debt clock. So no recovery there. And looking at that other one where automation, this one right here, non-farm private payroll employment, I think there's automation kicking in here to not replenish those lost jobs. And that might take many years to bring it back up. Other than that, that's about it. We shall talk to you later. Hopefully this will help you out. Thanks for watching.